In the years after the 2008 crisis, large banks were under intense pressure to appear steady, fewer surprises, smoother earnings, and a strong fortress image. JPMorgan Chase had a unit designed to support that message, the Chief Investment Office, often called the CIO. The CIO's job, in plain terms, was to manage the bank's excess deposits and liquidity in a conservative way, aiming for safety, stability, and protection against broad market stress. Inside that seemingly calm mission, the CIO also ran a credit portfolio that used derivatives, especially credit default swap (CDS) indexes, to reduce risk. In principle, this can make sense. If you are exposed to corporate credit risks somewhere in the bank, buying protection can offset losses during a downturn. The problem begins when a hedge grows so large, complex, and sensitive that it starts behaving like its own profit engine, an internal trading book whose size alone can move market prices. That is where the London Whale nickname enters the story. The trades were associated with JP Morgan's London-based team within the CIO, and the positions became so big that other market participants noticed unusual flows. The core instrument set involved credit index derivatives, tools that can be used for hedging but also allow highly leveraged exposure to changes in credit spreads. When used carefully, they can be protective. When scaled aggressively, they can become fragile. At first, this portfolio was presented internally as a risk-reducing strategy, but over time, multiple forces pushed it in a different direction. The desire to earn extra return in a low-rate world, the belief that the bank's overall balance sheet could absorb volatility, and the quiet confidence that the team's models captured the risks. A key danger in modern finance is that the same products can look safe in a spreadsheet while behaving very differently in real markets, especially when the position is huge. By early 2012, that gap between the story, a hedge, and the reality, a massive, complicated position, began to widen. What made the situation especially educational is that the early warning signs were not mysterious. Rising complexity, growing position size, and difficulty explaining the trade clearly to non-specialists. Those are classic indicators that a risk control story is weakening. When the market moved against the position, it did not merely create losses, it exposed how challenging it is for large organizations to recognize, communicate, and correct a problem quickly when it is embedded in technical details and institutional pride. The Senate's later investigation describes this as a case history of derivatives risks and internal breakdowns, highlighting how a portfolio framed as protection evolved into something far harder to manage. To understand why the London Whale episode grew so large, it helps to picture the CIO credit portfolio as a risk offset that slowly gained a second identity, a place to generate performance. Credit derivatives can be liquid, scalable, and responsive, features that tempt teams to increase size when the strategy appears to work. In calm markets, small moves can look like predictable income. The danger is that what looks like smooth carry can reverse sharply when liquidity thins or the market starts paying attention to the position itself. A crucial detail is that size changes everything. A trade that is manageable at one scale can become unstable at 10 times that scale because exiting becomes harder. Your selling can push prices down further, creating a negative loop. The CIO portfolio reportedly became large enough that others in the market began adapting their behavior around it. When that happens, your hedge is no longer just a hedge, it becomes part of the market's structure. As the position grew, so did the complexity. Complexity can hide risk in two ways. First, it makes it difficult for senior leaders to ask simple questions and get simple answers. Second, it encourages reliance on models and metrics like VAR, stress tests, and correlation assumptions that can underestimate risk precisely when you most need clarity. The Senate investigation later described problems with risk measurement, limits, and oversight as the portfolio expanded, which matters because governance is supposed to tighten as positions become more significant, not loosen. Another subtle factor is internal signaling. In large organizations, teams often build narratives. This is defensive. This is diversified. This is temporary. This will normalize. If the portfolio is labeled as protection, it may receive a different level of scrutiny than a pure profit-seeking book. That label can reduce friction, fewer challenges, fewer escalations, fewer uncomfortable questions. Over time, the label becomes a shield. Then there's the psychological trap. When a position becomes public knowledge in the market, it becomes emotionally harder to reduce it. Cutting the trade can feel like admitting weakness. It can also invite external attention. So teams may manage the trade by adding adjustments, shifting exposures, or seeking a market turn. Choices that can look reasonable in the short term, but increase fragility. This is an educational point worth lingering on. The dividing line between hedging and trading is not the instrument, it is the discipline. Hedging is defined by tight linkage to a specific exposure, clear limits, and an exit plan when assumptions fail. When those anchors loosen, you can still call it a hedge, but it begins living as something else. By spring 2012, the CIO's credit derivatives exposure was no longer a quiet internal offset. It was a position with enough mass to influence pricing, attract scrutiny, and become hard to unwind smoothly. That set the stage for the moment when the outside world began to notice, and when the bank's internal challenge became a public story. Early signals often arrive as whispers, small anomalies in pricing, unusual flows, traders discussing someone big in a specific corner of the market. In the London whale story, those whispers grew louder when journalists and market participants began pointing to a large, concentrated position connected to JPMorgan's London CIO desk. The situation changed overnight, from internal risk management to an event shaped by public perception. Once a position is widely discussed, it can become a magnet for opposing trades, not necessarily out of hostility, sometimes simply because the market sees an imbalance and attempts to correct it. If one participant has become a dominant buyer or seller, others may anticipate that participant will eventually need to reverse course. That anticipation can move prices against the dominant holder, even before the holder acts. For JP Morgan, the challenge wasn't just the market moving in the wrong direction, it was the difficulty of reducing a giant, complex position without worsening the outcome. Unwinding large derivatives positions can be like trying to turn a massive ship in a narrow channel. Every move affects the water around you, and the water pushes back. As losses began to mount, communication became crucial. When a bank's leadership tries to reassure investors and the public, it must strike a balance: calm without minimizing, confidence without dismissiveness. In this case, the issue became prominent enough that it demanded leadership attention and public disclosure. Over time, JP Morgan acknowledged that the losses were far larger than initial estimates. Many observers remember the early figure of roughly $2 billion being discussed, followed by later recognition that the full impact would be much greater. This sequence matters in an educational documentary because it shows how loss estimation can become a moving target when positions are hard to value and markets are shifting. In less liquid conditions, pricing becomes less certain. Internal marks can diverge from external reality, and every attempt to exit can change the market's reference points. That can make the loss feel like it is chasing you, because your own actions to reduce risk can move prices in ways that create new losses. A second educational theme is reputational momentum. JP Morgan had been widely viewed as one of the stronger risk managers among global banks. That reputation, while earned in many areas, can also become a vulnerability. It creates expectations, and it can make it harder for an organization to recognize that it is drifting into a danger zone. When the market begins to question that reputation, it can intensify scrutiny and increase pressure to provide clean explanations quickly. The outcome was a highly visible loss event connected to derivatives trading activity within a unit that many assumed was conservative by design. Later reporting often cited a total trading loss in the range of over $6 billion. The FCA's enforcement announcement, for example, explicitly frames the matter as serious failings around the CIO's London whale trades. By the time the dust began to settle, the story had moved beyond a single bad trade. It had become a lesson about how quickly complexity, scale, and communication gaps can turn a risk-reducing intent into a public and expensive problem. When people hear London whale, they often picture a single trader and a single oversized position. But the deeper educational story is organizational. How controls, metrics, and decision making can drift when a business unit believes it is acting in a protective role. One commonly discussed issue was the reliability of risk metrics. Risk numbers can create comfort, especially when they are presented with precision, but precision is not the same as truth. If a model assumes normal market conditions, stable correlations, or smooth liquidity, it can underestimate risk exactly when conditions change. The Senate investigation later highlighted weaknesses in risk management practices, including how the portfolio's risks were measured and communicated as the strategy evolved. Another issue was limits and governance. Limits are supposed to be the guardrails that prevent a team from drifting into dangerous territory. Yet, in large institutions, limits can be adjusted, reinterpreted, or temporarily relaxed, often with reasonable sounding justifications. The market is unusual. This is a hedge. We need flexibility to manage the position. Each justification may seem practical in isolation. Together, they can widen the road until there are no guardrails. Valuation discipline also matters. With complex derivatives, there can be legitimate debate about fair value when markets are stressed or less liquid. But if internal valuations consistently paint a more favorable picture than external pricing, the gap becomes a form of hidden risk. Even if no one intends to mislead, optimistic marking can delay necessary action. By the time reality forces a correction, the position may be harder to exit and the losses larger. Then there is the human factor, escalation. Many large failures are not caused by a lack of intelligence, they are caused by delayed escalation. People hesitate to bring bad news upward, especially if the trade is complex and the leadership expects reassurance. If early concerns are framed as technical noise rather than risk signals, the organization loses time, the most valuable resource in a fast moving situation. The London Whale episode also demonstrates how a unit's mandate can blur accountability. If a desk sits inside a group labeled investment or treasury, it may not be challenged like a front office trading desk. That can lead to fewer independent questions, less skepticism, and weaker everyday pressure to prove the trade's logic in plain language. A useful documentary framing is this: complexity can become a social strategy, not intentionally, not maliciously, but functionally. When something is hard to explain, fewer people challenge it. When fewer people challenge it, it grows. When it grows, it becomes harder to challenge. This loop is one of the most important lessons for anyone learning about modern financial risk. The educational takeaway is not derivatives are bad. The takeaway is that derivatives require an especially high standard of governance because they allow large, nonlinear exposures that can change character quickly. If an organization is not willing to enforce that standard through limits, transparency, and escalation, then even a strategy labeled defensive can become unstable under pressure. After a major loss event, an institution faces two tasks at once: reduce the immediate risk and rebuild trust. In the London whale case, JPMorgan had to unwind or stabilize exposures while simultaneously responding to regulators, investors, and the public narrative. Those tasks can pull in different directions. Risk reduction may require time and careful execution. Public trust often demands speed and clarity. Over time, the regulatory response became substantial. Multiple authorities examined what happened and why the controls did not prevent the situation from escalating. The outcomes included large financial penalties and formal findings that the bank's practices around the CIO derivatives trading activity were unsafe or insufficiently controlled. In the United States, the Office of the Comptroller of the Currency announced a $300 million civil money penalty related to unsafe and unsound practices tied to the CIO's derivatives activities. The U.S. Securities and Exchange Commission also brought charges centered on disclosures and controls, and its press release notes JPMorgan agreed to pay $200 million and admitted wrongdoing in that settlement. In the United Kingdom, the Financial Conduct Authority announced a £137,610,000 penalty for serious failings relating to the CIO's London whale trades. JP Morgan publicly addressed these outcomes as well. In its investor communications, the bank described reaching settlements with multiple regulators connected to the CIO trading matter, reflecting a coordinated resolution across agencies. But penalties are only one dimension. The internal repair process is equally important in the educational story. Major events like this often lead to leadership changes, restructuring, tighter oversight, and revised risk frameworks. The most meaningful reforms typically focus on three areas. First, clarity of mandate. If a unit is meant to be conservative, its permitted activities must be clearly defined and enforced. Second, independence of risk control. Risk managers must have authority, not just advisory status. Third, transparency to senior leadership. If a trade cannot be explained in clear language, it should not be allowed to grow. A subtle but powerful lesson is how institutions learn. Sometimes they learn the wrong thing, becoming more secretive or more defensive. The healthier learning is to become more explicit. Clearer governance, clearer reporting, clearer responsibility. The London whale case is often studied precisely because it shows what happens when a sophisticated organization underestimates how quickly risk can move when scale, complexity, and market attention collide. For listeners, the value is not in memorizing the instruments. The value is in recognizing the patterns. When a strategy's explanation becomes harder, when limits become negotiable, when models become the primary source of comfort, and when early concerns are not escalated with urgency. A good documentary ending doesn't just recap events, it gives the audience a mental toolkit. The London whale story offers several durable lessons that apply well beyond banking. The first lesson is definitional. Hedging is not what you call a trade. Hedging is a discipline. A true hedge is linked to a clearly identified exposure, measured with realistic assumptions, constrained by firm limits, and designed with an exit plan when the world changes. If the hedge grows large enough to influence market prices, it becomes harder to claim it is simply reducing risk. Scale can transform intent. The second lesson is about complexity and governance. Complex positions can be managed, but only if the organization's governance becomes more rigorous as complexity rises. The opposite pattern, complexity rising while oversight weakens, is a warning sign. When a strategy becomes too technical for decision makers to challenge, the institution has effectively delegated judgment to the model. Models can help, but they cannot replace responsible skepticism. The third lesson is about communication under pressure. Large organizations often struggle to deliver timely, consistent explanations when a technical problem becomes public. The risk is not only financial, it is narrative. If early estimates shift dramatically, trust erodes. A strong risk culture prefers uncomfortable truth early over comforting ambiguity. The fourth lesson is the market's reflexivity. When others see you as a dominant participant, they may trade around your expected needs. This is not about villains or heroes, it is about incentives and positioning. If the market believes you must exit, prices can move in anticipation. That is why liquidity planning is not optional when positions are large. The fifth lesson is personal courage inside institutions. Many failures escalate because people postpone difficult conversations. If you are a manager, a risk professional, or an analyst, the most valuable skill is not technical brilliance. It is the ability to escalate clearly, early, and respectfully, even when the topic is uncomfortable. A system that discourages escalation will eventually pay for it. Finally, the London whale story reminds us that modern finance is not only about numbers, it is about human behavior interacting with complex systems. A trade can start as protection and become a fragile machine. A metric can start as guidance and become a shield. A reputation can start as strength and become overconfidence. If you want one sentence to carry forward, it is this: risk does not disappear when it is wrapped in sophisticated language. It simply becomes harder to see.